When the dot-com bubble burst back in the early 2000s, it wiped out something like $6.2 trillion in household wealth. Just vanished.
Astounding numbers.
And then, just a few years on, the housing bubble collapsing took out over $8 trillion more.
It's almost hard to comprehend the scale.
It really is.
Yeah.
And it's not just numbers on a page, is it? These aren't just market corrections. They genuinely ruin people's lives.
Absolutely devastating, socially and personally.
So it just brings up these massive questions. Why?
Yeah.
Why does this keep happening again and again? Why can't we seem to, I don't know, learn? Why don't we learn the lesson?
Yeah, that's the million-dollar question, or maybe the trillion-dollar one. The easy answer people grab is just greed. Everyone's greedy.
Right. That's what you always hear.
But it's frankly too simple. We often find this, right? People make choices that, yeah, they regret later, often with bad information, or maybe logic wasn't front and center. But the key thing is, those choices made sense to them in that moment. So just blaming greed makes us miss the real lessons about how people rationalize things that look greedy later on. Bubbles aren't like a clear medical diagnosis.
Oh, simple test result.
Exactly. It's more like the rise and fall of a political movement or something. You know the outcome, but ask 10 people why it happened, and you'll get 10 different answers. The causes are never fully agreed on.
That's a really helpful way to think about it. So less of a moral failing, more about rational choices within a specific, maybe flawed context.
Precisely.
Okay, so if simple greed isn't the main culprit, what is this crucial, often overlooked reason we're diving into today? What's our mission here?
Our mission, really, is to unpack the central idea that investors, often quite innocently, take their cues from other investors who are playing a completely different game.
Different games.
Yes. There's this idea in finance, sounds perfectly reasonable on the surface, but it's caused, well, almost incalculable damage. It's the idea that any given asset, a stock, a house, has one single rational price. But that completely ignores the reality that investors have vastly different goals, different needs, and crucially, different time horizons.
That idea. One rational price. And it does sound fundamental, but when you put it like that, yeah, it seems misleading. How do we figure out a right price then? Like, take Google stock, a huge company. How much should you, the listener, pay for Google stock today? What's the right price?
Well, see, that question itself is flawed without more context. The answer totally depends on who you are.
Right.
If your time horizon is, say, 30 years, you're saving for retirement way down the line.
Okay.
Then the smart price involves, a pretty sober analysis of Google's discounted cash flows over decades, estimating future profits in today's terms.
Makes sense. Long-term view, long-term calculation.
But what if you're planning to cash out in maybe 10 years?
Shorter time frame.
Yeah. Then the price you'd pay might hinge more on your analysis of the whole tech industry's potential over that decade. Can Google's management actually execute their plans? Different calculation.
Okay, and what if it's even shorter?
Right.
Like you're looking to sell within a year.
Now you're looking at total different things. Current product sales cycles, maybe. Is a bear market coming? Things that affect the next few months.
Right. Immediate pressures. And then the day trader.
The day trader. For them, the smart price is almost, well, who cares? Is maybe putting it bluntly, but...
Yeah. Blunt, but probably accurate.
They're just trying to skim a profit off tiny movements between now and, lunchtime. That can happen at almost any price level, as long as it moves predictably for a few hours.
So who cares about the 30-year plan?
Exactly. So a price that looks utterly ridiculous, completely insane to the 30-year investor can make perfect sense to the day trader. Because their focus, their goals, their entire game is different.
Different games, different rational prices.
Which leads us to what I think is an iron rule of finance. Money chases returns, wherever it can find them. So if an asset starts showing momentum, consistently moving up, it's actually not crazy for short-term traders to jump in, assuming it'll keep going up. Not forever, obviously, but just for the short time they need it to.
Right.
Momentum attracts short-term traders, and then, like you said, it's off to the races.
Yeah.
Bubbles really form when that momentum, those short-term returns, attract so much money that the whole makeup of the market shifts. It goes from mostly long-term holders to mostly short-term traders.
The balance tips.
Right. And it feeds on itself. More traders push up returns, which attracts even more traders. Pretty soon, the people setting the prices, the ones moving the market minute to minute, are the ones with the shortest time horizons.
Okay, I think I'm getting this. It's not that people suddenly become irrational gamblers overnight.
Not necessarily.
It's more that they've rationally shifted to a different game where the old rules like long-term valuation just don't matter for their immediate goal.
Exactly. That's a great way to put it.
So bubbles aren't really about valuations soaring sky high. That's just a symptom.
Right, the symptom.
The underlying cause is time horizon shrinking. More and more short-term players flooding the field.
Precisely.
Let's make this concrete.
Right.
The dot-com bubble in the 90s. People call it irrational optimism.
Common narrative.
But think about Yahoo. Stock in, say, 1999. Valuation looked crazy to anyone thinking long-term. Absolutely nuts.
Through the roof.
But if you were a day trader,
Yeah.
playing that short game, it made perfect sense to pay a high price. You could make your money whether Yahoo was at $50 or $500. Didn't matter, as long as it moved predictably that day.
And it did move. For a long time.
Yeah. And remember the headlines back then. Record trading volume. All the time.
Oh, yeah. Constant churn.
That screams high-frequency buying and selling,
Yeah.
right? Short horizons. People weren't thinking 20 years ahead. The average holding period for a stock in 99 was apparently just 4 months.
4 months. That's barely long-term thinking at all.
And Maggie Mahar, in her book Bull, pointed out how the media focus shifted to quarterly reports in the mid-90s. That just fueled performance chasing. People piled into mutual funds right when they were most expensive.
Chasing last quarter's winner. Classic short-term behavior.
Exactly. It was the era of day trading, short-term options, constant market commentary. Not exactly a long-term investor's game.
And what's truly wild is how this exact same pattern, this dynamic, played out just a few years later. Different asset, same game shift.
The housing bubble.
The housing bubble. Mid-2000s. Paying $700,000 for a basic 2-bedroom house in Florida. It's really hard to justify that if you plan to live there, raise a family for 10, 20 years.
Almost impossible based on local incomes or rents.
Right. But if your plan is to flip that house in a few months, sell it to someone else for even more in a rising market.
Then it makes perfect sense.
Totally rational for that game, and loads of people are playing it. There's data from Adam, the real estate tracker.
Yeah.
It shows house flipping defined as selling more than once in 12 months went up 5 times during the bubble. 5-fold. From about 20,000 flips a quarter in 2000 to over 100,000 a quarter in early 2004.
Wow. A huge surge in short-term players.
Massive. And then, bam, it collapsed right after the bubble burst. Those flippers, they didn't care about price-to-rent ratios or long-term income growth. Completely irrelevant to their game.
Irrelevant.
The only thing that matters was, will the price be higher next month than this month? And for years, the answer was yes.
Until it wasn't.
Until it very suddenly wasn't. So putting it all together, bubble formation isn't really about rational people suddenly becoming irrational long-term investors.
Okay.
It's more about people somewhat rationally shifting their strategy towards short-term trading to capture that momentum, which has been feeding on itself.
Makes sense.
I mean, what do you expect people to do when there's clear momentum creating big, fast profit potential? Sit on their hands.
Not likely. Money chases returns, like you said.
Never. Not how humans work. Profits will be chased. And those short-term traders, they operate in a zone where the normal rules of long-term investing, especially valuation, they just get ignored.
Yeah.
Because they don't apply to the game being played by them.
Okay, so we've got the short-term game creating this momentum, fueling the bubble.
Yeah.
But now, here's where it gets really damaging, right? For everyday people,
This is the collision point.
it's when the long-term investors playing their game start taking cues from the short-term traders playing that other game.
Yes. The signals get crossed. Badly.
Think about Cisco again back in 99. Stock shoots up 300%, hits $60 a share. The company's valued at $600 billion.
Insane.
Objectively insane by any long-term metric.
Right. Few people actually thought it was worth that. The day traders were just riding the wave. Burton Malkiel, the economist, he pointed out that for Cisco to justify that price, its implied growth rate, meant it would have to become bigger than the entire U.S. economy within 20 years.
Which is just mathematically impossible.
Preposterous.
Utterly preposterous. BUT. If you were a long-term investor back then wanting to buy Cisco, $60 was the price. That was the market price.
That's the only price on the screen.
So maybe you look around, see everyone else buy and see the price soaring, and you think, wow, maybe they know something I don't.
The fear of missing out.
Yeah.
FOMO.
Exactly. Maybe you jump in. Maybe you even feel smart about it for a little while. And that's the terrifying part, isn't it? In the moment, it's so easy to see that rising price and think everyone else can't be wrong.
Yeah.
They must see something. How do you fight that urge, that herd instinct?
It's incredibly difficult because what you don't realize is that the traders setting that price at the margin, the ones pushing it to $60,
Yeah.
they didn't care about 20-year growth prospects. They were planning to sell before the closing bell, hoping it would tick up to $60.50.
Just looking for pennies.
Pennies or dollars, but very short term.
Right.
But that $60 price, for you, the long-term holder, it was a ticking time bomb, a disaster waiting to happen.
And the two types of investors, they don't even know the other exists, really.
Rarely. They're just on the same field, running different plays, maybe even running right towards each other without looking.
And bam.
Yeah.
Someone gets hurt in the collision.
Someone gets hurt. And it's fascinating because so many decisions in finance and investing, they really are rooted in watching what other people do. You either copy them or you bet against them. But if you don't know why someone is acting a certain way, buying that stock, flipping that house, you have no idea how long they'll keep doing it, what might make them stop, or if they'll ever learn their lesson. You're flying blind following them.
It's like when you hear a commentator on TV, on CNBC or wherever, saying you should buy this stock.
Right. Generic advice.
You have to remember, they have no idea who you are listening at home. Are you a teenager with pocket money? Are you an elderly widow trying to preserve capital? Are you a hedge fund manager playing some complex strategy?
Vastly different needs and risk tolerances.
Can't we seriously think those three people should all buy the same stock at the same price? That the current market price is magically right for all of them? It's just illogical when you break it down.
It is, but psychologically, it's really hard to accept that other people who seem rational see the world through a totally different lens than you do.
Yeah.
Especially rising prices. Man, rising prices are like a drug. They can seduce even the most disciplined, value-focused investor into becoming a wide-eyed optimist.
Detached from their own strategy.
Totally detached, pulled into someone else's game simply by the allure of the rising price. And this idea, being swayed by people playing a different game, it's not just money, is it?
No, it's a great point.
It can mess up how we think about all sorts of things. Spending habits, career paths. We look at others, we admire what they have.
Sure.
We see the fancy car, the big house, the nice clothes, the great vacations. But what we don't see are their goals, their anxieties, their specific circumstances, or maybe their huge pile of debt.
Right. The hidden context.
It's a huge trap. Have you ever caught yourself doing that? Kind of unconsciously following someone else's script?
Oh, definitely. That point about not knowing why someone acts really hits home. I think about spending. You see someone with a certain lifestyle, maybe a young lawyer, like you mentioned, trying to make partner. They need the expensive suit, the fancy car, the right address, maybe. It's part of their game, their career strategy.
Right. It's an investment for them, potentially.
But then maybe working from home, see that lifestyle and think, oh, I should have that too. But I don't need it for my game.
You're just copying the spending, not the potential payoff.
Exactly. Spending the money without getting the career boost he might be getting. We might even like the same things, but we're playing totally different games. It took me years to really internalize that. It leads to disappointment if you're not careful.
It really does. Which brings us to the core takeaway, I think. Few things matter more with money than truly understanding your own time horizon.
Knowing your game.
Knowing your game, and crucially, not being persuaded by the actions and behaviors of people playing different games than you are.
So what does this mean practically for you listening? The biggest thing you can do is actually take the time to identify what game you're playing. It sounds simple, but it's amazing how few people actually sit down and define that.
It really is. There's this sort of implicit assumption that everyone labeled investor is on the same team, playing by the same rules, like they're all on a basketball court together.
Yeah, all aiming for the same hoop.
But once you realize how wrong that is, how diverse the playing fields and goals are, you see how vital it is to just define your game. What are you trying to achieve? For instance, years ago, I actually wrote down my own investing mission statement. Sounds a bit formal, maybe, but it helped.
What did it say?
Something like, I am a passive investor. I'm optimistic about the world's ability to generate real economic growth over the long run, and I'm confident that over the next 30 years, that growth will benefit my investments.
30 years. A very specific time horizon.
Exactly. And that might sound simple, almost quaint,
Powerful.
but incredibly powerful, because once you have that written down, once you know your game, everything else that doesn't align with that mission, it just becomes noise.
Yeah. Like what the market did this week or this year even?
Mostly irrelevant to a 30-year plan.
That pundit yelling on CNBC.
Irrelevant. It gives you this amazing filter to cut through the chaos and stay focused on your objective.
That's a really actionable piece of advice. Define your game. Write it down. So let's wrap up this deep dive. The big insight today. These destructive financial bubbles. They're not just about greed. That's too easy.
Far too easy.
They're deeply connected to this dangerous, often invisible collision between different people playing different investment games on the very same field, driven by shrinking time horizons and people getting sucked into following cues from players whose goals are completely different from their own.
Well put. It's about that mismatch and the momentum it creates.
And understanding that gives you a powerful lens to see markets, and maybe other things, differently.
Which leads to a final thought to leave you with. If recognizing your own financial game and tuning out the noise from other players is so critical for your financial well-being, what other areas of your life could be significantly improved by doing the same thing? By clearly defining your own objectives, your own game, and consciously avoiding being pulled off course by the actions and expectations of others who are fundamentally playing a different game than you are.